If you're a young doctor looking to get onto the property ladder, but you feel priced out, overwhelmed by loan rules, or unsure how to even start, this episode will shift your whole attitude.
I had one client who bought a property, but it was signed before the scheme changes and it was only settling after. It was an extended settlement and they were meant to be paying LMI, and we had a formal approval with mortgage insurance attached.
Yeah.
And then we realised with the changes they could qualify for the LMI waiver, and they saved like 40 grand of mortgage insurance.
Oh, that's beautiful.
It was so
That's beautiful.
fortunate.
Most doctors don't realize there are tens of thousands of dollars in government incentives, grants, and tax saving strategies they're eligible for, but missed completely. And some of these can mean the difference between buying your first home in the first year after graduating or waiting for 5 and missing out. Today's guest is our in-house mortgage expert, Alissa Childs at IFD Lending. She's helped hundreds of professionals just like you access government schemes, bypass common loan pitfalls, and structure smart ways to buy with less cash than you think you'll need.
I've worked in this industry for 25 years. I've never seen a guarantee deal go bad. The banks don't want to put a guarantor into a guarantee if they're not of sound position. We have to get legal advice independently. Go and see a solicitor, get this all explained to you. These are your risks and obligations.
We'll walk through the 5% no LMI deposit scheme, parental guarantees, first home super saver strategies, and real examples of how doctors are leapfrogging their way into the market without waiting to save for a hefty deposit. Now let's dive in. Hi everybody, welcome back to another episode of the Investing for Doctors podcast. I'm your host, Dr. B. And today we have Alissa back with us today. Hi Alissa.
Hey B.
Welcome back.
Thank you.
For those that have not listened into one of your previous episodes, give us the quick summary of what you do and who you are.
My name's Alissa and I am co-founder of a mortgage brokerage firm called Two Birds, One Loan, and we are based in Glenorrhea in Sydney. We've been lucky enough to start working with the IFD group for the last 12 months or so.
Yeah. Excellent. And we're obviously doing the mortgage brokering for our Investing for Doctor clients. Yeah. So welcome. And, we had a really interesting conference in November. And I think there's some learnings that came out of that. And, I'm going to use these episodes as sort of like the post-conference debrief. And one of the things that I think some listeners and also some of our members have mentioned to me in the past is that, we've got a new scheme for first home owners and we haven't really touched on that. And so I think we'll dedicate this episodes for the younger generation of doctors looking to get in on the property ladder and how the first home sort of grants and schemes are helping.
Yes.
So obviously, the one that the government is sort of really advertising is the old, I think, first home owners grant that has been now renamed to the 5% deposit scheme. Is that correct?
Every time they rejig this scheme, they change the name, which is very confusing. So it was called the first home guarantee and now it's called the 5% deposit scheme.
Yeah.
But essentially, this is where the government provides a guarantee. So essentially, you can borrow up to 95% of the property purchase with no mortgage insurance.
And it can the lender's mortgage insurance.
Insurance.
LMI,
And it can save significantly on the cost of entering the property market as a first home buyer.
Yeah. So, for those that are getting onto the property ladder, they've never come across these things before. So I guess, explain to us what the LMI actually is.
Okay, so lender's mortgage insurance is a fee that you pay to protect the lender when you have less than 20% deposit. So essentially it's a premium that is capitalized to the amount of lending that you're borrowing. And it is there as like a risk fee because there is not a lot of equity in the property. So if you were to default on the property, the mortgage insurer would be covering the cost of, so the bank had to sell your property and they did not recoup the amount of money they need. The mortgage insurance will cover the difference for the bank there. So you pay the premium. You pay the premium to protect the bank when you have a small deposit.
Yes. And historically, that's sort of pegged at when you exceed 20, sort of 80%.
Correct.
lending.
So the premium is quite small, sort of 80 to 85.
Yeah.
And under $1 million, the more you borrow and the less deposit you have, that premium can go up all the way up to like sometimes $40,000 or $50,000, depending on the scenario. So it's
and
quite
roughly what
significant.
percentage is the LMI?
Oh,
It's
actually,
not
I'm
a
not
fixed
even sure.
percentage,
It's
isn't
not.
it?
No,
Yeah.
and it varies between banks. They all have different insurers that they use. They all have different calculations.
Yeah.
But essentially, if you're borrowing 95% plus mortgage insurance on, say, a $1 million property, you could be essentially borrowing close to 98% of that property.
So it's about 3% roughly.
It could be, up to, depending on the circumstances.
Yeah, and obviously that's not you don't want to be paying that because
No.
you don't get, it's almost like a entrance fee to borrow
up
money.
your deposit because when you're paying stamp duty and lender's mortgage insurance, these are fees that don't even contribute to your 5%.
Yeah.
So straight away that can, vanish someone's deposit just by paying the stamp duty and LMI.
Okay. So for most doctors, which, we're in the profession that banks like us because we tend to be safer borrowers, we tend to get away with 90% or sometimes in rare situations 95%, and that's already waived for us.
Correct.
Yes. Now then, what makes this scheme sort of different or similar to what we already have? Because I've seen some where it goes to 90%, some will go to 95%, but I think a lot of banks will lend up to 90% to doctors without LMI. Is that correct?
It is still a bit of a niche policy. Not all banks will do that, but there are plenty that will. But as a doctor, there are things you might not realise that some banks require a full registration with APRA before they'll give you that LMI waiver. So, for a doctor who's started, an intern, for example, might not qualify with a lot of the banks for that mortgage insurance waiver. So that's one situation where you might consider going under the scheme as opposed to waiting for the full registration. But really the LMI perks as a doctor are probably a little bit better than what you're going to get as applying under the scheme. And one of those reasons is that the under the scheme you are obligated to live in the property whilst the guarantee is in place. Whereas if you buy a property to live in with an LMI waiver as a doctor and 6 months later you think I'm going to move out of that property and rent it out, you can do that. Which you can't do under the scheme.
And you can do that as an investment property as well.
Correct.
Obviously.
So it's a little bit limiting. I would say if you can apply as a doctor as opposed to as a first home buyer for that particular scheme, I would go with the doctor's LMI waiver if you qualify. And there's also price caps as well under the scheme. Depending on the state, they have all just increased. They were really low. As an example, in New South Wales, I think they were recently 900 and they bumped it up to 1.5.
I think, and that was the main change recently, wasn't it?
There was two big changes.
1st of October.
1st of October, that was one of them. And the second one was that they removed the income caps. So the income caps were really limiting.
I think it was like $100,000 or something.
It wasn't. No, it was 200 per couple. And 120 per individual. Really quite, with these two caps in place, not a lot of people qualify. In Sydney in particular, you can't buy anything for 900,000.
Oh, and you can't even get the serviceability with your income cap.
So, exactly. No, I think they obviously listened to the feedback, but they've really opened the floodgates. And business has just gone crazy. And I think the flip side of all the changes they've made is the prices are probably going to go up.
So, and did you find before this change, the number of people applying for this, first home guarantee or 5% deposit scheme was sort of quite
less
limited? Because they didn't meet the various
exactly. They didn't meet the
means
the
test.
limitation. That's right. But I've had clients who bought. I had one client who bought a property, but it was signed before the scheme changes and it was only settling after. It was an extended settlement and they were meant to be paying LMI and we had a formal approval with mortgage insurance attached. And then we realised with the changes they could qualify for the LMI waiver. So we had 20 days till settlement after the 1st of October. We had to reapply with another bank, get them under the scheme, and they saved like 40 grand of mortgage insurance.
Oh, that's beautiful.
That is beautiful. Fortunate.
Yeah. So it sounds like the scheme is really good, and it's actually helped a lot of first home owners get onto the ladder.
Yeah,
I mean,
it's been great.
I think from a policy perspective, it's probably good that you keep them in the property until the waiver is over, because then if they, there are people who want to rent vest and they're probably just utilizing it to buy the first property.
Yes, that's
you want
right.
to avoid that. In a way.
And I think I don't know how they monitor that, and I've not had anyone move out and
well, it hasn't been long enough, I guess.
I mean that has always been the rule, like as long as we've had this in place, but I assume the bank would be tracking it, because you update your address, you've moved out, then you wouldn't want to be audited and have to repay have that reassessed.
Or actually pay the LMI.
Yes.
I haven't heard of any cases where
I haven't either.
That has fallen through and then someone has to pay LMI or something.
No, we haven't had any cases like that.
Okay.
So I'm not sure of how they audit it, but they do say you need to live in it whilst the guarantee is in place.
And obviously the thing is that if the valuation of the property has gone up or you paid down some of the equity, is there a formal way to be released from the scheme, or do you have to do something there?
So we would organise that. So we actually, for every client we settle, we monitor the price point of the property versus the loan amount every 6 months and the interest rate. So every 6 months we'll look at every loan, and if there's a guarantee, whether it's parental, government, we will assess whether we can remove that guarantee. And yes, there is a bit of a variation process. With some banks it's a bit more straightforward than others. CBA, for example, want you to do a full internal refinance.
Oh, really?
Whereas some will just release the guarantee with a variation sort of form. But we do track it, and it's important to track it.
To be released from that, obviously. Yeah. And it's also good for the homeowner to know that the value of the property has gone up as well.
Right. Yeah.
That's always nice. Okay, so anything else we need to really know about the scheme, apart from the fact that the caps are different in every state?
They're quite significantly different per state.
I've got this in front of me. Like Tasmania is like 700,000.
Yeah, it really jumps around. So it's just important to understand what they are. But again, if you qualify for a Dr. LMI waiver, it's not really relevant. But no, there are other first home perks, and one of them is the stamp duty concession.
That's
once
state-based.
Again, this is state-based as well, so it does vary from state to state. But the again, they probably need to update this because it's like in New South Wales, for example, it is waived up to 800,000 and it's discounted between 800 to $1 million. Over $1 million, it's full stamp duty payable. So
so under 800,000,
it's a full waiver.
It's a full waiver. Is that only for new builds or is it for existing builds?
No, that's all properties.
For all property.
Yeah. So the only first home benefit that is specifically relating to a brand new property is the first homeowner's grant. So that's the $10,000 grant that you get if you purchase or build a brand new property. I guess that's also one of the reasons the government want to move away from first home guarantee and first home owner grant, because that's so similar. I know,
I don't know. Maybe that's the reason why they changed it to 5%, because I think earlier I also mismentioned, I called it a grant rather than a guarantee.
Yeah, it's two different things. The grant is actually just a payment that you receive. And truthfully, like we haven't had a huge number of people apply for that or qualify for that. So not a lot of people are buying brand new as a first home buyer.
Because the stamp duty waiver is a stamp duty concession. At least, I mean, we're talking about New South Wales. So in New South Wales, there's a stamp duty concession where the property is less than I think 800,000 for new property and 650 for existing or something like that.
No, it used to be 650.
Was it the same for both now?
Yeah, I think it's up to 800 now is a full waiver, and then it's stepped.
Oh, okay.
It's discounted between 800 and $1 million. But, the closer you get to $1 million, the discount is very minimal. There's not a huge discount.
And then if it's a new or substantially renovated home, then you get additional $10,000 as a grant.
Correct.
Yeah. Okay.
Yes.
So it's actually two things. It's a stamp duty and a grant.
Yeah, two separate. There's actually three. Yeah. So it's three separate schemes
what's the
essentially.
third one
So
then?
the grant, the stamp duty exemption, and then the LMI waiver. So they're actually three separate schemes.
Yeah, but the state one has there's two separate things.
Yes.
And what about the other states? I mean, it
does vary.
There's a whole list of it,
Yeah,
obviously.
there is. And off the top of my head, I haven't memorized every single state, but they are all quite different. And like just the stamp duty, for example, in Victoria, it's quite a lot more than other states.
Yeah.
So if you're assessing someone for a purchase, the deposit they need in New South Wales versus Queensland versus Victoria can vary quite a bit depending because the stamp duty jumps up and the concession rates are lower, or the price caps are quite a lot lower in Victoria. But that will get reviewed because the prices down there are going quite crazy at the moment.
Yeah.
I'm sure they'll review that. But the costs to get into the market in Victoria are a bit higher.
Yeah. So I guess the summary of that is that yes, we got a federal 5% no LMI guarantee for first home owners.
Yeah.
And then every state has a first home owner's grant, which is basically a cash payment for first home owners if you meet certain criteria. And then there is a potential stamp duty waiver or discounts.
That's right, depending on your state.
Depending on the means tested and all that sort of thing.
Yes.
Yeah. So it's a three
There's a lot
things.
of variables. But so we will just ask all the questions up front to get a clear picture of what you would be eligible for as a first home buyer, depending on where you are.
Yeah. And obviously depending on the means test, it's easier to get some, harder to get some. And every state is different. So it's a very personalized thing about how much you need to borrow and all of that sort of thing.
And they used to limit the number of these that they would give out for the 5% scheme. They used to have a certain number, but they've removed that.
They've removed
now.
the cap.
So now we've just
everyone
opened open the floodgates, which is good.
Yeah.
It's helping people
good.
get in.
Yeah, because what it does is it allows the people who are renting to get in and actually own their own property.
Yeah,
because
that's right.
that deposit was just so huge.
That's right.
To get in.
And actually, that's another factor to mention is that some banks will allow you to, because most of the time you would need 5% genuine savings to get into one of these schemes. But CBA, for example, will look at your rental history and they'll go, you've got 6 months rental history, you don't have a genuinely saved deposit, those people can get a gifted deposit if we show their rental history. So it sort of helps the people, because if you're paying rent, sometimes it's hard to save when you're paying probably the equivalent of a mortgage repayment in rent. So they'll say, okay, well, you've shown stability in your ability to pay rent consistently and on time at a certain level. And so if your parents are giving you your 5% deposit, that's fine.
Oh, okay.
So
is that giving them the money or sort of loaning them the money, or is
gifting?
Gifting
is what it would have to be like a non-repayable gift. But it just, because otherwise the rule is that you have to have 5% genuinely saved, which is 5% deposit of 5% of the purchase price in your bank account over 3 months.
Oh, right. So it's over a period of time.
Yes.
It can't be just
right. So if that whole 5% hits your account yesterday,
it doesn't
that's
count.
okay if you have rental history.
Yes.
If you don't have rental history, they want to see that you've
so there's a wiggle room about that.
Depending on circumstances.
No, that's very good to know, because I think a lot of young people need some assistance from their family, and 5% is actually not too terrible amount. To save. I mean, A, to save up, and also B, to receive as a gift. From parents who want to help their kids get onto the property ladder. So now those are the two things that obviously have come in recently, and also the state-based ones have been around for a bit longer. But there's another scheme that is often talked about, but it sounds like not a lot of people are aware of it or using it, and that's the First Home Super Saver Scheme. I think it's the FHSS.
This is not widely used or spoken about.
Yeah. Do you come across that much at all?
We get asked once in a blue moon about this scheme, but essentially you can put money into super and then you can pull it back out, like additional super payments, and you can pull it back out and use that for your house deposit.
Yeah. So it's very interesting that not so many people
I know.
use it because it's
I'm
actually
not sure that it's quite known.
yeah, it's actually quite a good scheme when you look at it. You know, I'll go in my views of it because I think what it allows you to do is it allows you to contribute up to $15,000 of concessional
Correct.
super.
Yeah.
Sorry, concessional contribution into your superannuation. And when you do that, you obviously get a tax benefit from it. Because when, you know, if you are paying into that, you only pay 15% in super and versus
your normal
whatever
tax rate.
your marginal tax rate outside of super.
Yeah.
Which is nearly always going to be higher if you're going to put that amount of money in anyway. And so you get a tax saving then. And then when you take the money out, they give you a 30% tax break on the money you take out anyway, or something like that.
Yeah, it's something like that. And I honestly think it's probably just not widely understood or advertised. But then obviously you still have, you know, if someone is a good saver, that would be a better way to do it than just putting it into a high interest
saving account.
Yeah.
So then my question is that if I was putting in money in as under FHSS, could that be used as the 5% deposit?
It would be, yeah.
It would be, right? So theoretically, if you, and I think just to go through the different sort of terms of the FHSS, it's only money that you've put in as voluntary contributions. So whether that is a concessional or non-concessional contribution. So for the concessional, it gets taxed at 15%. The non-concessional, it doesn't get taxed at all because you're using after-tax money.
Yeah.
And I think you can contribute 15,000 per financial year, and it accumulates to a maximum of $50,000.
Yeah.
So you need roughly 3 years to contribute that. Or if you're at the cusp of the financial year, it's about two years and a little bit to get the maximum of it, right? I think when you then take it out, there's also some tax concessions given to the money that's taken out. It's only taxed at I believe 30%. As in when you pull the money out, you get a 30% tax offset against it. So you're basically earning whatever you put it in, and then you're taking out is another 15% in a way.
You'd have to do a spreadsheet probably.
There's a spreadsheet. We should do a spreadsheet on that, right?
We should.
To
compare it to the alternative of just putting that into a savings account.
Oh,
it would be really
way
good.
better. I've done the superficial maths on it, and it's way better. And you know, perhaps with, you know, we'll attach a spreadsheet to this podcast and show that. But at the end of the day, if your marginal tax rate is at the 37%, it's such a tax privileged environment to do that. And if that contributes to your 5% deposit, then,
that's right. That's the point of it. Yeah,
that's the whole point of it, to utilize these two schemes together. But obviously, you need to plan ahead because you need 2.5 years or so to do that.
Do the salary sacrifice.
To do the salary sacrifice or to do the voluntary contribution ahead of time. And I think the additional thing they allow you to do is that the money that's been put in there, they also add this like a nominal interest rate on it, where you can take out a bit more than what you put in. So it's all very. It's good. It's a very good scheme for people to save, I believe.
It is actually, because you don't see the money.
Yeah, you don't see that's the main thing, right? Because if you have it in a high interest saving account, you always look at it and it's very easy to take out.
But this you can only pull out for the purpose of buying your house. I think it's a great way. And then if you're salary sacrificing it from your employer to put directly into the super, you just start living off a smaller net figure of income that you don't even think about what's going away.
Yeah, so and lo and behold, you have the deposit. And the great thing about it is that if you're coming in as a couple, you could have $250,000, and that's way more than a 5% deposit.
For people that can live off, what would it be per annum? Like it's just over $1,000 a month.
It's just a little bit over. Yeah, it's a bit over $1,000 a month.
Most people wouldn't even notice that out of their pay.
Yeah,
depending on what you're earning.
Yeah, exactly. So it's a very good strategy. And if you have, I believe that if you have, say, parents that are going to gift you money, and you know that you're going to buy a property, and you're at the cusp of a financial year, you can dump in 15,000
Yeah.
here, and on the other side dump in another 15,000, and you get 30,000 in the scheme. So I think it's so underutilized.
It actually is. And I'm actually thinking about we should get our marketing person to put together some information about it, because I honestly think it's just because people don't understand or don't even know it's there.
Yeah, or how to utilize it. I think that's the other thing, because it does require you to plan ahead.
That's right.
But in this day and age, most people, when they start working, they start planning to buy a property, and so
probably
why not?
something they should think about doing when they first join the workforce straight away.
Absolutely. So I think this is something that we could work on and try and get that together. But obviously there is there's also limitations to the scheme, so you got to just be careful. If you don't end up utilizing it, then it just goes past your super. So it's not lost anyway.
Yeah, well, that's right.
You can't take the money out though. That's the problem. I think. So
not for any other purpose. I believe it just has to be for the house.
Yeah. So there's I'm just surprised that not as many people use it. But
we probably need to push it a little bit more.
Yeah,
so
just
people
to make people
understand
aware of
or do
what
some
that
videos
does.
or explaining how it works.
Absolutely. We'll take some snippets from this video.
Yeah.
Now the other thing for first home owners is I think we previously touched on it, is the parental guarantee.
Yes.
Yeah. Now
these are amazing.
How does this work in the scheme of things? Say I'm already a first home owner. I may not, if I don't qualify for one of these, the 5% LMI, how does a parental guarantee
they're so good. So with these, you can actually borrow up to 105% of your purchase price. So you can get in with little to no
money at all.
Yeah.
Yeah.
Because the 105 generally will cover all of your costs. Sometimes we have people forego their first home benefits altogether. An example of this recently, I had a young couple who, as first homeowners, they could purchase a unit in Sydney. And their sort of thinking was, the units don't get the growth.
Yeah.
They really don't compared to a house. So they're like, how can we, if you weigh it up, if we were to buy a house now, that could go up a few $100K in the next 5 years.
Yeah.
The unit will not. So the first home benefits might have meant $50,000 to them.
Yeah.
Whereas they're looking at the 5-year plan going, well, this house, if we can buy a house, will get us to, we could buy something for $1 million and it might go up to 1.3, that they say that may double every 10 years. So they actually got a parental guarantee. They only had a $50,000 cash deposit. They're buying for $1 million an investment property. They're foregoing their first home benefits. They're going to buy a freestanding house in Sydney for $1 million with a loan of $994,000.
Okay.
They're both living at home with family, and that's the other thing, is that when you're assessing for an investment purchase, the two of them live with their parents.
Yeah, they have barely any cost.
They have no expenses.
Yeah.
We do have to factor in $650 per month per person as a minimum, as a board expense. But their borrowing capacity just shot right up because we're factoring in a house, we're factoring in a house rental income, and the notional rent as opposed to the owner-occupied unit. So for that scenario, they were like, we don't need the first home benefits. We're just going to get into the market with the house, and then we just keep reviewing the equity there. And So that was interesting.
And that was with
parental guarantee.
With a parental. Yeah, and how does that process work? Did the parents guarantee for the 20% or?
Essentially, yes. In that scenario, we're borrowing $994 on $1 million. So
that's
basically,
nearly 100%.
It's almost 100. They still have $50,000 to put in. That covers the stamp duty. Essentially, they don't have to do that. They do have to service the whole amount themselves. There's no mortgage insurance. So what the bank will do is it place 80% of the debt against the borrower's new house, and the remainder of the debt will be secured by the parent's property and the new property. So in this case, the mother was providing her property. She has a mortgage already with one bank. We are taking a second mortgage. behind that bank, so she doesn't have to move her banking at all. our new bank will register a second mortgage. There's equity requirements for the parents.
Yeah.
And then often like to see if it's an owner-occ property, the parents are providing that the parents are in a strong financial position.
Yes.
They're still working ideally.
Yeah.
They don't have to be. Each bank has different appetite for this.
Yeah.
But essentially, that whole deal was quite niche, but fit within one of our lending panels with a major bank, and it's all been pre-approved. And there's weird and wonderful ways to get in.
Yeah.
You just have to know the policies.
Yeah. And so, they didn't have to pay any LMI. They also got probably a reasonable, interest rate.
Yes. So these are all priced at 80%, the parental guarantees and the home guarantee schemes and the Dr. LMI waivers.
Yeah.
They essentially will give us a good rate for all of those deals. Yeah.
Okay. And then so now that you have something like that, at the end, you still have to get out of it, right? And how does that look like?
Releasing the guarantee.
Yeah, releasing the guarantee.
So like I said, we would, and not every broker would do this, but if your broker doesn't approach you, you should approach them every 6 months for a property report to measure against what you're owing. And once you hit 80%, we get the guarantee off straight away. So usually, this can happen within 12 months, 2 years. It depends on what you've bought. I've had other guarantees in regional areas that are still in place now because those prices don't go up so fast.
Yeah,
but
so just rely on paying down.
I had one property in Perth. They bought for 1.25. And then in 18 months, I think it was up to 1.7. So we got the guarantee off for them straight away. And they went in to that purchase, they borrowed 100%. They only had a 20K deposit. It's cash. And it was a guarantee. They borrowed essentially the whole amount. They made 500K on this property in 1.5 years.
Yeah.
In Perth, that was.
And so when you do something like that, you still have to have the serviceability to pay for the 100% loan.
Yes, that's right. So servicing will always come from the borrower. But when we release the guarantee, we don't have to reassess you as a borrower.
Yeah.
We just have to prove to the bank that you now owe 80% of your own property. And they're like, great.
Yeah.
Get the guarantee off. It's a simple form usually.
Yeah.
We just provide a valuation on the remaining property, a variation form, a release of security form, and we just take the guarantee off.
Okay.
So ideally, in an ideal world, the guarantor won't even really know. They know, like as in it's not going to affect them day to day. 100%. There's a lot that goes into getting these established, but it doesn't affect them. It will only affect them if the borrower's default. And then the bank will sell the borrower's property first. And if they don't recoup the whole amount, they will then call on the guarantee. So it's a limited guarantee. They can only call on the amount that has been guaranteed.
Yeah. And so if they have the guarantee, then they can say either pay cash to pay it off.
Yeah, exactly.
In the worst case scenario.
They can pay it off by any means. But to be honest, I've worked in this industry for 25 years. I've never seen a guarantee deal go bad.
Yeah.
And I've worked at a lot of banks where we've done guarantees.
Yeah.
And, I've been a broker now for 7.5 years and I've never seen one go bad. And that's the ideal. But there's a lot to sort of protect the guarantor. We have to get they have to get legal advice.
So they have to get independent legal advice.
Independent, that's right. So go and see a solicitor, get this all explained to you. These are your risks and obligations. And then obviously the banks don't want to put a guarantor into a guarantee if they're not of sound position. So, they're not going to take mum's property if that's her only property and she's got no super and she's 80 years old and she's got a loan on it already. Like that's not the type of scenario that this would work for. They don't want to put anyone at risk.
Yeah. And when they do that guarantee, if there's an existing mortgage on the property, then they take the second mortgage. How do you have to get permission from the first mortgagee for that?
Yes, they do.
So it's an additional layer of complexity there.
Yes, but I believe that the first mortgagee can't actually say no.
Right.
To the second mortgagee, but they do have to authorize it. So there's a process that part of our process and the bank's process is there's a form that goes and says you need to consent to the second mortgage, but I think legally that the first mortgagee has to consent.
Okay.
But there are strict equity rules around it.
Yeah, you can't obviously then over leverage them.
They don't want the two loans generally to be more than 70% of the value
Added
of the
together.
property.
Yeah.
And then the second mortgage, for example, can't often be more than 50% of the value of the property. So there's lots of rules. Well, we'll guide everyone.
There's
Lots of policy
rules
checks
and,
that we do up front to make sure that it all qualifies and fits with the bank that we're working with.
I mean, from a common sense perspective, the second mortgage can't be too big, and it can't bring the that property into too high an LVR.
Right.
Yeah. And so I guess when you said 70%, it can't be more than 70%
combined.
And then combined with the two mortgage, and you don't want it to that second mortgage to be too big.
More than half of the
if
value.
it's more than half, that means the property you're getting the second mortgage on is
not valued as high as what we're buying.
Exactly, right? That's a much lower value. So 20%, 50%, 20%, that's almost like double.
Kings or mums in a cottage house.
Mom's little apartment is getting leverage for your mansion.
But there are lots of tests and policies in place to protect the guarantor. And like I said, I'm sure they do go bad, but in my experience, I haven't had any cases.
And just be prudent in the kind of clientele you select for what their what their work, what their assets look like.
That's right.
And that's probably that's the bit where the broker like yourself really helps them. But it definitely sounds a lot more complicated than just getting a straightforward loan. The guarantee almost sounds like it's double, if not triple, the work.
They are. A lot of work goes into them, and we have to obviously, there's generally 4 people that we go through the whole interview process with, and we need to make sure they're getting their independent legal advice. So that sometimes can hold up settlement because there's wait times to get to see solicitors, and there is a lot more work. The second mortgage can sometimes create more work. But look, you just have to go with someone who's experienced and knows what they're doing, and they're actually quite straightforward. If you're using the right bank and you know what the policies are and whatnot.
Okay, so I guess I think we've talked about all of the things that we can help sort of first home owners to get onto that ladder. Let's just do a bit of like a scenario play because that's probably the easiest way to think about it, and how to a new doctor, for instance, who's starting off in January next year, they want to get onto the property ladder as soon as possible. What are the considerations they need to do, right?
I think, it's all just circumstantial to their situation. But
they're quite generic. Most interns are quite generic.
Everyone is quite different. But to be honest, I've done a few doctors that have completely put the first home benefits to the side and they're just going straight in for investment. So they're generally living at home with family still and they're just wanting to get their foot in the door with their first purchase. So, doctors don't always take out these first home. We're often doing their first purchase would be an investment, and we'll just say, you won't get these first home benefits, and they're like, it's just part of my strategy is to just get the property, get another one, just keep leveraging, and especially doctors that are getting incomes that are going up and up and up. They'll get one, and then so that's one 6 strategy. Months later to get another one and another one. And
so that's one strategy is the rent vesting, where you don't need the 5% guarantee. You probably you're not going to get any of the first homeowner grants, and you basically say, okay, I'm also going to ignore the first home super saver scheme. That's a lot of money or benefits off the table.
I know, but sometimes the growth of what you can buy as an investor will outweigh
is more than what you can get.
The saving that you'll make to buy something smaller as a first home owner. Like the other example, if your only option with your budget is to buy a unit, and that might grow or not grow, which I've seen. I've seen units that have stayed still stagnant, for 8 years.
Absolutely. Or ones that have just gone down in value immediately.
Gone backwards. Or not valued up straight off the the bat.
Yeah. I think the main thing I'm considering is that the first home saver scheme.
Yeah.
I mean, that obviously has to be for your first home owner
Yes.
occupier. But I believe you only have to live in it for a short period of time.
So you have to move in for 12 months. Within 12 months is the current rule, I believe. So that's another thing they change a lot. So it used to be that you had to live in it for 6 months and you had to move in within 12. But now I believe it's move in within 12, stay in it for 12 for some of them. But the 5% scheme, you have to stay in it until the scheme is the guarantee is removed. So that's quite limiting.
Yeah, so I'm going to workshop this, almost in a way that you can potentially just forego that 5% no LMI because whatever you have as a doctor could be good enough. Once you get full registration, use the first home saver scheme to get that first home, live in it for a year, and then convert it to investment. And you'll probably be like tens of thousands of dollars better off compared to if you didn't utilize that.
Yeah, but I think it's probably important to plan ahead either way.
And, planning ahead always helps.
We talk to people that come to us and they say, I'm not going to buy until next year, but what do I need to know now to get here by this time?
Yeah.
And that's fine, completely obligation-free
Yeah.
meetings with people that aren't ready to go, but at least we can sort of give them some guidance on what they should be doing now to get in when they're ready.
Absolutely. So I guess if you're a first home owner or you're contemplating buying your first home, it's always good to have that first conversation early.
Yeah, I think just to plant some seeds around the options
what you need to do, what you can do, because there's just so many schemes and as we discussed, sometimes we don't even know what's happening. We gotta look it up because they constantly change. And,
they do.
The
that's
around.
Right. But it's just good to just plant the seeds as well around, especially if super is something you can do.
Because that's
I'd always recommend getting tax advice on that probably because it is a tax sort of saving strategy.
Yeah, absolutely.
But we should put together some sort of comparison on that.
Absolutely. Yeah. I think so. So I think we'll try and get that done as when this episode goes live, and then hopefully it'll be in the link below and we can go from there. But I think moral of the story is if you're planning a first home, to buy a first home, it never hurts to have a conversation early, have a chat with someone like yourself, just to see what are the numbers you need to get to the kind of property you want to buy.
And the goal, what's the 5-year goal?
Exactly, what's the goal? Think about the first home super saver scheme because that needs obviously forward planning and it needs some manual input into salary sacrifice to actually get the true value of that scheme. To all the interns starting in January, welcome to the profession and hope we get you on the property ladder soon.
I know, we've dealt with a few interns.
Yeah, excellent. Thank you for coming in, Alissa.
Thank you. Thanks for having me. It's always a pleasure.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.